Welcome to our second last class of FAC 1501, and today we are doing revision. We are looking at all the study units that we have done from unit 1 up until unit 11, in preparation of the upcoming 3 assessments that are coming shortly, of which the first one will be assessment number 4 or assignment number 4, which counts 40% towards our earmark, and the second one is assignment number 5 for those who feel that they might have not done well on number 4, to do number 5 as well. And it also counts 40% towards your final mark. However, the higher marks of 4 or 5 will then be considered. And there will be the final assessment, which is the exam, of which I think the details will be communicated direct to you. Today we'll look at these 8 items, the big picture. This is the overall accounting from start to end, and we'll delve into the topics that you have requested that we in the previous class. You have requested that you require some second bite on them, or us to revise them, and we went and looked at those, which is the accounting question, and we'll have a second look at the cost of sales. We'll also have a look at the error correction, and we'll have another look at the closing of accounts, and we'll also look at the bank reconciliation statement, and the last one will be depreciation. Then we'll talk about the upcoming assessment. So our time might not be enough to cover everything. However, I will try that we be quick on the topics that are much more easier, and spend some time on the topics that are a bit complex and very, very, very important, such as depreciation. So let's start with the big picture. This is the big picture which I got from Encyclopedia, and it kind of summarizes the whole process that we follow when we are doing accounting, from number 1 up until number 8 there, of which of course number 1, this is where we identify transactions. Here where we identify transactions, most of the time there will be a list of transactions that have happened. ABC has bought 1, 2, 3 from DEF, etc., etc. Those are that is the step of identification of transactions, and it also includes the source documents. This is where things start. Sometimes those who work for the SMEs, you'll find that there is no one or no list somewhere which lists these transactions. However, there will just be a pile of invoices and receipts, of which I think in this module we'll do justice to that. Most of your learning material, where we are dealing with the stage of transactions identification, more especially on unit 2, 3 back there, we try and draw the receipts and invoices for you, so that we can almost match the real life interactions with this stage of transactions identification. So after that, the transactions get recorded on the journals. These journals It's your cash receipts journal, cash payment journal, purchases journal, sales journal, those books that we have dealt with earlier on in unit 5, 6, 7, I think 5, 6. Those are the books. Those are the books of first entry. Sometimes we call them books of first entry. Those are the journals where this gets recorded. Even though in practice you will barely find an accounting system which has something called cash receipts journal. In practice, you might not necessarily see it as such. However, in the background, the systems will be recording exactly those transactions. You might be calling it making a payment or allocating cash book or whatever that it might be called in practice. But that's exactly what is happening. What happens on those books of first entry. Then these transactions, they then get posted to the general ledger. You will recall the T accounts that we speak about, and I think we're still going to speak about today, since they were requested as one of the important areas. That is a very important section of accounting. So they get posted when you are done with your cash receipts, cash payment, and all those books. The transactions get posted to the general ledger, where meaning if it's a cash receipts journal, you're going to take the bank column total and you post it on the bank account. Cash payment journal, bank column, total column, you post it to the credit side of the bank account, etc., etc. Then when you are done, you balance those accounts, of which balancing the accounts we're going to talk about today. You balance those accounts. After balancing, you take those balances and you now prepare or post them to the trial balance. And I think I should mention here before I move to the trial balance that in practice sometimes most of the systems they jump all those other steps that I spoke about, because most of the businesses nowadays are almost automated or digitized, where you are not going to have a receipt. There will just be a feed of transactions that has happened in the bank, which comes to the accounting system, and that feed most of the time, because there is no human intervention between the transaction initiator and the recording, it will just go straight to the general ledger. And there is a book of first entry called general journal, which you should understand more or less how it works, because that's more or less how general ledger looks like, where all these transactions, they will just be posted on the relevant account in the general ledger, straight transactions one by one on that general ledger. So now, at the end of the day, in practice, here academically, when you are done with closing the general ledger accounts, the T accounts, you then transfer their balances to the trial balance. Trial balance that book, which is having a debit and a credit and a description, where you record all the balances, all assets, income, expenses, liabilities, equity accounts. You record them there on the trial balance after you have closed them. And in practice, the trial balance sometimes it just becomes a summary of the general ledger, or we can put it that way, that the trial balance is a summary of the general ledger, because it takes all the accounts, general ledger accounts, and summarize them in one page, or in one document, or in one place. Then that becomes the trial balance. Then that's where you after that, that's where you will now record the adjusting, post the adjusting entries. Of course, you are posting them in the general journal or general ledger, or straight on the trial balance. We've seen last week when we were doing depreciation, how you can then jump all these stages and record straight on the trial balance when we're adding and subtracting the items. So that's where you will do your adjusting journal entries on the trial balance. This adjusting journal entries, they will include various things that would have not come through the normal transaction cycle. Your depreciation is one of them, where they will tell you that these assets have this percentage of depreciation. So you will then now come and do those adjusting journal entries to record them. If there are other we call them post balance sheet events. If one of your key customers has been liquidated, as an example, you'll recall last week we dealt with one of the construction company which was or is in the process of liquidation, and we were told that the business is not going to get any money from the liquidation. So meaning you have to write off the debt that they owe you. That becomes the credit loss, which will then come and record those transactions through the adjusting journal entries. And then you will then have the post-adjustment trial balance, meaning this trial balance here, it will be adjusted by these journals that you will have done here. You now have post-adjustment trial balance. Then you use the trial balance to make the financial statements. Financial statements, it's the key report in financial accounting. In effect, the reason why we learn financial accounting is so that we can be able to draft the financial statements, so that we can be able to understand the financial statements. So after the post adjustment trial balance, you will then create the financial statement. The financial statement consists of 5 parts. One, the statement of profit and loss and other comprehensive income. 2, the statement of financial position. 3, the statement of changes in net assets, or statement of changes in equity. That's what it's called sometimes. It's the same thing. Changes in net asset or changes in equity. It's the same thing. Then there will be the notes to the financial statements. And those who will deal with the public sector financial statements, there is an additional item called the statement of budget comparison, or budget statement. The budget statement is in and between, in the mix there. And when you are done with the financial statements, I think in level 3 accounting, you will learn about the analysis and interpretation of the financial statements. This is where most of the financial analysts, they use that information, your net profit percentage, your current ratio, your debt equity ratios, and all those things. You'll learn them in the 3rd level of doing accounting. Then you have closed your books. You can roll over to the next reporting period, or the next financial year, when you are done with that part. And this rolling over to the next reporting period, it's something that we're going to touch on a little bit as well. In practice, you barely really do it manually. The systems will roll over for you. However, you will have to press a button somewhere to say roll over to the next financial year. If financial statements are prepared on a separate financial statements preparation softwares or systems, like your Caseware, the Caseware has a button where you press and say roll over. Then it will roll over. What it will do on the background is going to close all the accounts for you and open the next financial year. Let's say you are rolling over on 31 December 2025. It's going to close all the accounts as at 31 December 2025 and open new accounts for 1 January 2026, and they have opening balances on the general ledger of all those accounts for that particular period. And here, academically, the process is exactly the same as what we do when we say we are closing off the account. That amount there, which we call balance brought down at the bottom of assets and liabilities account, that is the amount which you will now open as a balance carried down in the next reporting period or the next financial period. That's when we say you have closed the accounts. And remember, the income and expenses accounts, they close off to the profit and loss, so meaning they will not have the opening balance. Only assets, liabilities, and equity accounts will have the opening balance. So the income and expenses will not have. Like I said, this is the revision class. That was the big picture. Let's move on to the next topic number 2 of 7. The next topic deals with the accounting equation, of which I have prepared something that we will do together. Before we go to accounting equation, I want to repeat this. This is one of the most important sections of accounting. When they say a person is an accountant, it means that person is mastering this, what is on our screen now, understanding this. In the previous class, somewhere at the end of July or beginning of August, I requested that those who do not understand, please make a screenshot of this section and make it the wallpaper of your phone, so that whenever you look at a phone before you unlock it, you see this particular screen, so that it can sink in the deeper part of your brains. So assets, all assets accounts, they increase on the debit side and they decrease on the credit side. All assets increase on the debit side and they decrease on the credit side. Assets, it's all those items that the business uses for a long term. Long term means more than 12 months most of the time, and things that they own. Of course, there are current and non-current, of which the non-current are the ones that will be used for more than 12 months. Things that the business own, the business property, as someone has said in our first class when she was explaining what is asset. Your bank account is an asset. Your property, plant and equipment is an asset. People that owe you, the monies that they owe you, they are your assets. Things that you are using in the business to generate income or to help you to generate income, they are your assets. Liabilities, they increase on the credit side and they decrease on the debit side. If you look, this is almost like an inverse or an opposite of the asset account. They increase on the credit side and they decrease on the debit side. These are the liabilities. Liabilities are things that you owe, items that you owe other people, such as the bond. If the business has bought a building through a loan from the bank, which is called a bond, the bond, that is a liability. Long-term liabilities like vehicle finance, if the business owns vehicles that are financed by the banks, that is a liability. If the business has bought inventory on credit, the money that they owe the suppliers, that is the liability. So liabilities increase on the credit side and they decrease on the debit side. Equity. This is what is equity in standard terms is defined as the net of assets and liabilities. So meaning what the owners of the business own, it then be called equity. That's why you see all the income and expenses, they get closed off on an equity account called profit or loss or retained earnings. That becomes an equity account, which means what the owners of the business own, or what the shareholders of the business own. So that becomes equity. And I think I should highlight that There are people called directors in the business. There is a difference between directors and shareholders. You learn that in commercial law, but I think it's important that I highlight here, because sometimes when we are doing assessment, we tend to want to confuse you with that as well. And if you don't understand the difference between the two, you might be in trouble. Shareholders are people who own shares in the business. Those are the owners of the business in a setup of a company. Shareholders are the owners. And the directors is just a glorified name of managers. There are people who are managing the business, just that they're bigger role than normal managers. However, they're just managers of the business. They're called directors. They have more responsibilities and more powers. However, they are just managers. So shareholders are the owners. Directors are the managers. So here, when we say equity is the money which is what the owners of the business own, we mean shareholders. What shareholders own is called equity. So equity accounts are not so many. If you see something called capital, someone buying shares in a business and stuff like that, that is equity. And there is an expenditure account called drawings, which gets closed on an equity account. I think we're going to, I don't think we'll look at it here. However, as you progress in your accounting learning, you will learn a lot about the drawings account, when the owners of the business are now taking money from the business, which will then be called drawings, which is not the same but similar to something called dividends. When the owners of the business are being given money at the end of the financial year, if the business has done well, when the company is declaring dividends, the dividends get closed off or net off here on the equity account directly. So that is the equity accounts. Then we have the income accounts. Income account, the increase on the credit side and the decrease on the debit side. Look at the pattern. The income and the equity, they all increase on the same side, which is the credit side. In fact, look at the pattern. Liabilities, equity, income, they all increase on the credit side and decrease on the debit side. So income accounts are all the income that we get, or revenue accounts. If you see revenue, income, those are same things, just using different words to explain or to describe them. So income increase on the credit side and the decrease on the debit side. And the income accounts, revenue, rental income, interest income, and interest, you must be very, very, very careful. If it's called interest income, it's an income. If it's called interest expense, it's an expenditure. Sometimes we won't mention whether income or expense. If we are earning it as a business, it's an income. And if we are paying it, it's an expenditure. So interest income, rental income, dividends received. As a company, we might find that we own other businesses. When they declare dividends, they give those dividends to that money to us. In a case where our company will be having owning shares or being a shareholder in other companies, when those companies declare dividends and they pay us the dividends money, it becomes income to us. Dividends received is income as well. Services rendered, it's income as well, etc., etc. All those accounts are income. And lastly, the expenses. Expenses, look at it, they increase on the debit side and they decrease on the credit side. And expenses, they look similar to the assets. Can you see assets and expenses? They look very similar. It seems like when we are paying these monies to buy assets or to incur expenditure in the business, is going on the debit side of these accounts. Of course, it will go on the credit side of the bank account or whatever other, the liability or whatever other account which is involved. So expenses, they increase on the debit side and decrease on the credit side. Expenses are things that we pay as part of the business, or we buy and or pay for as part of the business transactions. Things like your water and electricity, those are expenses. We pay or we buy them in order to utilize in the business. Water and electricity rates, rental expense for the business if we are renting a property. Interest expense if we have some monies that we owe the banks or other financial institutions. When we are paying, they become expense or expenditure in that regard. So this is the very important part of the accounting. Just to run quickly again for the last time: assets increase on the debit side, they decrease on the credit side. Liabilities, they increase on the credit side and they decrease on the debit side. Equity, they increase on the credit side and they decrease on the debit side. Income, they increase on the credit side and they decrease on the debit side. Expenses, they increase on the debit side and they decrease on the credit side. That is this general ledger accounts or the T accounts, and the same principles goes to general journal as well when you are debiting and crediting. The very same principles goes to the trial balance when you have done closing your accounts, when you are determining which account is going to debit and which one is going to the credit. These are the principles that you use. Let's move on to the actual accounting equation. Is there anyone who is still having a question on these T accounts or these general ledger accounts?
It's not much of a difficulty, but I just wanted to understand something. The income, when it decreases, so the income cannot be classified as an asset, the income and the equity. And said the equity,
okay, continue.
The owners of the business own. Yes, something like that.
Okay. Remember, there is difference between the shareholders or the owners of the business and the business. Even legally speaking, those are two different individuals. The other one is a legal entity. The other one is a natural person. It could be a natural person. So now, if I will give an example with Mr. Mutsipe. If Mr. Mutsipe owns African Rainbow Minerals, what Mr. Mutsipe actually owns is the shares in African Rainbow Minerals, is the shares in that particular company, not necessarily the assets of that company. The assets of that company are owned by that particular company. Let's say the mine owns a tractor which costs 2 million. Mr. Mutsipe cannot really say, I have an asset worth 2 million. His ownership is limited to the shares that he can say, I have 100% ownership of Rainbow Minerals, of which if he was the business and preparing the financial statement, Rainbow Mineral could be an asset in his books. On the other hand, Rainbow Minerals will have an asset called a tractor of 2 million rands, which they own in their business. So now, if coming to your question directly, if Rainbow Mineral now generates income from the tractor that I gave an example with, the tractor is owned by who? By Rainbow Mineral. The income that the tractor generates, whether it's services rendered, maybe it went and dig somewhere in the mine, in other mines, or whatever it has done to generate that income, is the income of Rainbow Mineral. So it's the company's income and not necessarily the shareholders' income. So Now the shareholders, of course, their own, the value of their ownership will increase, because when an income is increasing, it means there will be a profit, and that profit, when you close off the profit and loss account, it goes to a retained earnings, which is an equity account to link to your thinking. I hope I tried to paint that picture from beginning to end in a way that you will understand. Are you happy, Lisito?
Yeah, I get it, but maybe it's not addressing the scenario that was in my head.
Let's continue. Paint a picture. We can give you an example as well, please.
Okay, most people are told that if you have rooms in your yard, rental rooms, just do a business account, register a business account, and then the income from those rooms goes there. I think it's for tax purposes, but yeah, it could be a lot of things. But now the question is, you've done rooms that you own, and then with the rooms that you own, you don't sell them or you don't register them under a business. The business leases the rooms from you. So whatever income that the business is getting from the rooms, they still have to pay the lease by you. So what does that say when it comes to the equity as far as the assets in the business and everything? When you've just released the rooms to your own business where you are the own director and you seem to be paying yourself.
My understanding of what you're describing, I'm just summarizing it here, is that let's say you are a sole trader called Lisito Sole Trader, Lisito Sole Trader, and you own a house. In fact, let's start from the beginning so that you can get it well. And in fact, we can even use that as an example for our next section, so that we don't worry about time. So we'll ignore those other ones that I'd already pre-prepared. We'll use Lisito's example. You are a business called Lisito Sole Trader. You buy a house for 100, let's call it 1 million. Houses are very expensive. You buy a house for 1 million. When you buy this house for 1 million, initially, let's say you are buying it to rent it out. You are buying it to rent it out. See yourself as a business, the Lisito Sole Trader. You are buying a house that you're going to use as a business of a sole trader to rent it out. When you buy that house, let's assume you bought it for cash. So meaning, for business purposes, try now to separate two people. There is Mr. Lisito, who is the owner of Lisito Sole Trader. It's just unfortunately, when you are a sole trader, there is a blurry line between the two people, but I think there is a module 1602 or something like that, which deals with the partnerships. That's where we explain it very nicely, where you would be able to see the difference between the business and the individual, and how do we draw the line between the business and the individual. So now you are Mr. Lisito, you bought a house for 1 million and you want to use that house as for business. So for accounting purposes for your business now, this to me, it says Mr. Lisito has taken 1 million house and deposited it into the business as his capital to start a rental business. So meaning, in accounting equation for Lisito traders, assets they will increase by 1 million. They will increase by 1 million. I will just call it one. Yeah, let me write it. Which is the house, and then because you are the owner of the business or the shareholder of Lesotho Traders who has almost transferred this house from personal use, or who has bought this house in order to use it for business purposes, that becomes your equity. So meaning 1 million, it's your equity that you have added in the business. If we were talking debits and credits that we have just done now, it would have mean on the assets account, we will have an account, and the general ledger will have an account called assets, and you will debit 1 million. We will have an account called house or rental property or whatever you want to call it. 1 million, you will debit it. On the equity account, you will have an account called capital, which is 1 million. This is your capital that you have invested into the business. So now people come and start renting your house. You get the tenants there, they come and move into those rooms. And again, maybe before I go there can be a little bit of, not really a complexity, but a little bit of an addition here. You can do renovations in the house. When you do renovations, maybe in order to prepare the house to be rentable. Maybe you can add another 50,000, which it's for the renovations that you have spent. Renovations, you will learn them later on. Here I'm including them because I know some of you might be having a question around them, but we don't deal with them much on accounting 1. I think we deal with them in accounting 3, where there is something called there is the classification, whether they are an asset or they're an expenditure. It's dependent on whether they've improved the capacity and or the value of the property, or they were merely to restore the deteriorated value of the property. If they've just restored the deteriorated value of the property, they're an expenditure. If they've improved the value of the property, let's say maybe your house had 5 rooms, then you have added the other 3 rooms, then that becomes an asset. However, I'm not going to talk about them here, or I'm not going to record them here since they're dealt with in accounting 3, just for in case, so that you don't ask a question about that. So let's move to our rental income. People came in and rented your house for 20,000. When they are renting this house, remember they are renting from who? Lesotho Sole Traders. Then 20,000. Let's assume they've paid cash, even though there are complications here. In fact, I think I should tell you, most of the time rental is paid in advance, meaning at the beginning of the month. So meaning there is that prepaid income scenario which might come in. However, we've dealt with in detail last week. So now let's assume that here we're doing in arrears. They come and pay you 20,000 rent for the month of January or whatever month that we are reporting on. When a person has paid you rent, let's assume they've paid directly in your bank. It means on your asset side, your assets, which is money in the bank, is going to increase by 20,000. And on the other side, this is an income. This is where it might get a little bit confusing. This is an income. Income, let me go back here. I think this is where we're working. Income is here. Remember, we have agreed that income increase on the credit side, and income and expenses, when we close them off, they close off into the equity. So meaning whatever we get left with, it then comes and increases the equity at the end as part of the profit or loss, or retained earnings, or accumulated income, or whatever account that we call it. So now it means our equity is going to increase by that 20,000 as well, since the income is increasing by 20,000. Increasing by 20,000. If you go, for example, and do what? Let's not use, let's say you go and pay for water and electricity in the municipality. And you pay 5,000 for the month for water and electricity. When you pay for water and electricity, you are paying, meaning money going out of your bank account. You are paying, meaning money going out of your bank account. Then water and it means your assets are going to increase by your assets are going to increase by to decrease by 5,000, because you are paying from the bank account. And then on the other side, water and electricity, they are your expenditure or an expense, and expenses, they are an equity account, or they fall under, they get closed off on equity. And when expenses are increasing, they are reducing the equity. So meaning your equity is going to also reduce by 5,000 rands. That Lisilo, do you get it, or do you still have a question?
I thought maybe the 5,000 would go to liabilities, or maybe I'm getting it wrong.
You have paid. If, for example, what would have happened? Remember, you have paid with the money from the bank. If, for example, the statement said you have received a municipal account of 5,000 rands and you have not yet paid, yes, this was not going to be an asset, because you wouldn't have paid. It would have been a liability, because you are owing the municipality. But here you don't owe, because we are just being told that you have paid 5,000 to the municipality. To get the difference, it's all about,
No, I get.
is it cash or is it on credit? And I think that's very, very, very important. It can get you far in accounting, just understanding that, is it cash or is it on credit? But I think there is somewhere we will deal with it. I think it's when we are doing the bank recon. Somewhere in front of we will deal with it. Is it on cash or on credit? If we're buying something for cash, it means we're paying with the money from the bank. It means bank will be credited, or assets will go down. And if we are paying on credit, that is the trade payables, which is a liability in that regard. So that's what it is. That was Mr. Lisito's example, and I had some examples here, but I believe we have covered the principle. Is there anyone who's still having an issue, or not understanding, or not knowing how they are going to record these 3 transactions? Let's see by the raise of hands. If you don't understand, when we bought machinery for 400,000 on credit, how much assets are going to increase by, how much equity and how much liabilities. Which one do you not, are you not sure of? Number 1, number 2, or number 3? Uhlebonkosi. Uhlebonkosi. Your hand is up, but your mic is muted. No, actually something, this thing says you don't have a mic. I don't know. Maybe just write your comment on the chat. We'll have a look at it. And Lungile and your trade, to do trade reconciliations, I'm not quite sure, but when we do the closing the accounts, will allow you to speak.
Okay, thank you, sir.
Okay. Ketiwe?
Morning, sir. I hope you're all good. I'd like to ask on the first question where it says bought machinery costing 400,000 on credit from a supplier. I understand that already it's a liability. So I'm trying to find out if is that an asset or equity. I'm not sure how I will. Yeah.
Remember, this is the business which is buying a machine for 400,000. A machine is going to be used in the business, which becomes an asset, and we bought it on credit, meaning a liability. So it's an asset and a liability. Remember, equity, there are very few equity transactions that you will have. Only if you hear they say the owner of the business, the shareholder, has donated this and that to the business. Those are the only transactions that affect the equity, of which there are very few. Probably it will only be like one in an entire scenario. So all these other transactions, it's income, expenses, assets, liability. Unfortunately, it seems like your microphone is not working. Just type in the message. We will check it. If it touches, if we have already passed, we will come back to it accordingly. Okay, so that was the second the second topic of 7. Let's go to the third topic, which we were asked to just check my notes quickly before I get lost. We're asked to determine the cost of sales. This is nicely outlined in your study guides on page number 207, on unit number 7 of your study guides, page number 207. It has been outlined in a very nice way. However, we'll quickly run through it now. There are 2 inventory systems that we have. The first one is called the perpetual inventory system, and the second one is called the periodic inventory system. The major difference between these 2 systems is that on the perpetual, continuous, on the perpetual, all the times when there is a transaction, in fact, let me also be clear that this is about the sales transactions. All the times when we are selling something, we, in addition to the sales transaction, we also have to record the cost of sales leg of the transaction. I think that's perpetual inventory system. Then on the periodic inventory system, here we don't record the cost of sales leg of that transaction. We wait up until the end of the reporting period. At the end of the reporting period, we go as a business and go do a stock count. Probably if you have friends and family who work in retail, you will hear them saying, hey, today there is stock count, or this weekend there is stock count, I'm working. We'll go and do the stock count. Stock count is literally going to the storeroom and count how many boxes of inventory do we have, how many boxes of milk do we have, how many juices do I have in my inventory? How many paints do I have? After doing the inventory count, we then determine the value of that inventory, of which majority of the time we are going to tell you that the stock count was done and the closing inventory at the end of the period was worth this much. That is the main difference. Perpetual, continuous, you always calculate, add an additional transaction where you calculate the cost of sale, the part of it. And periodic, you wait for the year end and you do the stock count, then it will determine how much is your value of the inventory, and then you calculate the inventory. We all know the formula of calculating you calculate the cost of sales. We all know the formula of calculating the cost of sales from that page which I've mentioned: opening inventory plus purchases minus closing inventory. That is the formula. You must memorize that if you do not know it. And let's start with the perpetual inventory system. Who wants to, and before I ask a question, accounting transactions, as I've indicated when I was doing the big picture, they can be recorded either from the journal first books of entry, which are the journal books, your cash receipts journal, cash payment, or they can be recorded in the general journal, all of them, or they can be recorded in the general ledger, or we can jump and record them directly in the trial balance. So out of those three different areas where we can start recording, I have chosen that we record them in the general journal. However, the principle is the same. If we're saying debit bank here, or credit bank, or credit asset, or credit whatever here, it means if we're recording on the general ledger, we're going to open a T account called bank and debit it there, or credit whatever that we're crediting in there. If we're recording on the cash receipts or cash payment journal, or purchases journal, or purchase returns journal, it means under the bank column we're going to write the very same amount there. Please don't get confused. If you see sometimes general journal, or sometimes general ledger, sometimes trial balance, sometimes books of first entry, which is the cash receipts, cash payment journal, or whatever, the principles are the same. It's just that I chose that I will record this in the general journal. You can be asked to record them in the cash receipts, cash payment, or wherever where they fit in. So I chose the general journal. So the first transaction, they say, let me try to make it bigger. They say the following transactions in the general journal of BS Cleaners and ignore VAT. BS Cleaners uses perpetual continuous inventory system, and they have purchased vernitures, which is the inventory on credit, from Lever Brothers, who is the supplier, for 20,000. Please raise up your hands and tell us what are the two accounts that are involved, and what are we debiting and what are we crediting. We have purchased inventory on credit. Raise up your hands. How do we record these transactions on the general journal? What are the two accounts that are involved? And in fact, do both of them. For number one, what are the two accounts that are involved, and what are we debiting and what are we crediting, and why? And number two, what are I will give you a tip. What are the four accounts that are involved, and what are we debiting, what are we crediting, and why?
Okay. With the first transaction, purchased vernitures inventory on credit from Lever Brothers. That means Lever Brothers is our supplier. We purchased inventory from them. We are now liable to pay. That is liabilities. Inventory is our asset. It increases our asset. And then what are we going to debit and credit? We are going to debit inventory, and then we're going to credit trade payables, I think.
Trade payables. Same amount, right? 20,000.
Yes, same amount.
Okay. 20,000. I agree with you. Is there anyone who does not agree with that? Okay, go to number 2.
Okay, number 2, you hinted 4 accounts.
Remember, this is perpetual inventory system where when we are selling all the time, just remember that, Lungi, when we are selling all the time, we must add an additional cost of sale transaction. Yes, continue.
Okay, so that means that now that we are selling to our customers, we're going to debit bank with 30,000 because we sold for cash.
Okay.
And then we're going to credit sales. We made a sale and we sold it for cash. The cost of sales, I think that one comes after as a debit. And then we're going to credit inventory because as Senai, we just sold it, I think. I'm just not sure if cost of sales is going to be the same amount or if we have to calculate the cost of sales. I'm not sure.
Oh, sorry. And I think we didn't mention that. But on a normal question, we will tell you how much did the inventory cost. But now we'll assume that is the same inventory that we just bought. We bought it for 20,000 and we're selling for 30,000. So that's how it is. That's how it is. Is there anyone who disagree? This, remember, this is perpetual, continuous, perpetual. Perpetual only means there will be this additional transaction. Yes, ma'am.
Sorry. So that means for the bank, we are going to record that on as selling price. That's the 30,000, and then the cost of sales, like you mentioned, we're going to record it as 20,000. That is the cost price, the price that it costed us to purchase from those Lever Brothers.
Yes, that's correct. Yes.
Okay, thank you.
Yeah. So this additional leg, we will record it on the cost. But remember, here we're assuming that we have sold the varnishes that we have just bought up there. Most of the time, we'll tell you what was the cost of these items that we're selling, and when we're using the perpetual inventory system. Okay, is there anyone who's still lost here, who's not sure what is happening, so that we can talk to it again? There was a question about the trading account on the chat. Before I forget, this is the best way to explain it. Sometimes you use the trading account when you want to use it to calculate. It's very rare though. I think on the study material we've just shown you so that you will have an idea of what's happening, but it's very rare that you will find it anyway. Sometimes we use the trading account to determine the gross profit in this regard. So meaning the what do we call it? The sales and cost of sales accounts, they will be closed off to the trading account, where when, of course, there will be a T account called cost of sales. You will remember that because we have credited here, meaning on the credit side, or maybe let me just copy some 2 accounts here and work on them so that it makes more sense, even though time is not on our side. Yeah. I'll just try to paste them here. I hope they will allow me. Yes, there will be an account called, there must be 3. There will be an account called sales. This is the general ledger T accounts now. Remember we said we just chose to record them on the general journal. There will be an account called cost of sales, and there will be an account called trading account. If we tell you that please close off this trading account, please close off these accounts on the trading account. It means, let's assume these are the only transactions that we have in the business. If, of course, if we're having many, we're going to record many. It means sales, when it's credited there, it means that 30,000 on the credit side of the sales T account will have 30,000. When cost of sales is debited, it means on the T account or and under the cost of sales account, that will be debited. Then we'll close off these accounts with the and you will be told that close this off these accounts using the trading account. Then remember how to close the account. We're going to deal with it later on, but let me tell you again here. You take the totals, meaning the total of the debit side and the total of the credit side. On the sales account, the credit side is 30,000 and the debit side is 0. Which one is bigger? The credit side is bigger than the debit side. You're going to use the bigger one as your total. Then the difference between the smaller one and the total, which is 30,000 minus 0, becomes 30,000, which is the amount that you're going to put there, and you write trading account here. And this means that on the trading account, since this one is debited, on the credit side of the trading account, you are going to have sales here. Cost of sales, you do the same. Debit side is 20,000, credit side is 0. Which one is bigger? The debit side is bigger, meaning your total is going to be 20,000. Credit side is having 0. 20,000 minus 0, it's 20,000, meaning you will have 20,000 here on the credit side, and you will call it a trading account. Then when it's credited, a debit to an account is credit to another account, a credit to an account is debit to another account. On the trading account, it means you're going to have 20,000, which is called cost of sales. And then you close off the trading account with the gross profit. Similar principles. Which one is bigger between the debit and credit? 30,000 is bigger than 20,000, meaning your totals are going to be 30,000. Your totals are going to be 30,000, and 20,000 minus 30,000, it's how much? It's 10,000. It's 10,000. Then you will then call this gross profit if you are requested to do this. That's how it is, but you will barely find asking questions about this. These are the sidelines of accounting that we show you so that you can have an understanding on how they work accordingly. Okay, let's move on to the periodic inventory system while we're still on the cost of sales. On the periodic inventory system, remember what I've said. There is a formula of calculating cost of sales in the periodic inventory system, which is opening inventory plus purchases and minus closing inventory. Minus closing inventory. That is the formula which we use to calculate cost of sales on the period, end of the period when we are doing the stock count periodic inventory system. So who wants to volunteer to tell us what is the cost of sales here? To calculate the cost of sales, we are given inventory at the beginning of the period of 542,000, sales 912,000, settlement discount 16,000, purchases 425, purchases returns 13,500, and closing inventory 216,000. Let's see by the rest of end who wants to tell us how much is the cost of sales, or who wants to take us through how to calculate the cost of sales. Take us through, how do we calculate the cost of sales here?
Okay.
Sorry, Pato. Kutlwano's hand is up. Kutlwano, do you want to give it a try?
Hi, sir.
Yes, thank you. So sorry about that part. When I will deal with the difficult stuff towards the end. Kutlwano?
So we first have to calculate the purchases because we have the returns.
And how are you going to calculate the purchases?
You take the purchases of 425,000 minus 19,750, and then you will get 405,250. And then you put that aside, right? And then you're gonna take the 542,000, which is the opening inventory. You add it with the net purchases that you calculated. And then you're gonna do the cost of sales, whereby you're gonna take the 947,250, and then you minus it with the closing inventory, and you get 533,250.
So you will take. I was trying to do what you were telling me as you were speaking.
So
No, it's okay. So I got 737,250. Is there anyone with a different way of calculating it than what Kutlwano has just elaborated now? It seems like there is none. Okay, and before I move on here, I think it's important for me to emphasize, I know on the perpetual inventory system, we have demonstrated it using the general journal. The very same can be asked here on the periodic inventory system to say, record these transactions in the general journal. They will be the same way of recording them, except that because you are doing periodic inventory system, you are not going to have this second additional transaction of cost of sales. That's one. And two, this one here, which is called inventory, it will be called purchases. It will be called purchases because remember, you're not continuously or perpetually tracking the inventory when you are doing periodic inventory system. So it will be called pages. That is the only difference. The rest will be the same. So meaning when you bought the inventory for 542, you are going to debit purchases and credit bank if you bought it for cash, or trade payables if you bought it on credit. When you are selling it, you are going to debit bank 912 if you sold it for cash, and credit the sales for 912, and you don't add an additional thing. The very same goes to all the other items. That's how we deal with the cost of sales. We're not doing well with time. I hope we don't go too out. Lungile, I see your hand up.
Yes, yeah, I just wanted to ask that you try and increase those numbers. They look a bit small. And then my question was, given the you gave us the calculation for the periodic. Oh yeah, Paramile says increase your font. Okay, you gave us the periodic, the calculations there. Does it ever happen, say, Ogutsi, they don't give us the closing inventory?
yes, you work from up to.
Yes, continue, Kutlwano.
Yo, sorry, sir.
Yeah, continue. I know you were talking to yourself, but you were saying the right things. Continue. Or it's just a coincidence, we were talking about something else which fits into our puzzle. Okay, yes. Sometimes you will be told, remember when we were dealing with inventory, we kind of shown you how to calculate the value of inventory at the end of the period. Remember when we did the first in, first out method, the weighted average method, the last in, first out method. I think there is one unit dedicated to that. Sometimes, yes, you will be asked to determine, but it's almost straightforward. You will be able to see it, because just giving an example like here, when we were saying this is the perpetual inventory example that we have just done not so long. However, we are just using these figures as an example. If this was periodic inventory system, we're going to tell you this 20,000 when we bought, we're going to tell you how many units we have bought. Let's say, for example, for argument's sake, these units were also, when we bought them, these units, they were 5,000 units or quantities of whatever that we're buying, of these vanishes that we have bought. There were 5,000. And when we're selling here, we sold for 30,000, but you get told that you sold 4,500 units or 4,500 quantities. So at the end of the period, you may have to determine how many are left at inventory and not yet sold, of which, with your eyes, without open eyes, without even a calculator, you're able to see that we bought 5,000 and we sold 4,500. It means I'm left with 500. And when I'm left with 500, how much is the value of this 500? Remember, there were 20,000. 20,000 divide by 20,000 divide by 5,000. I think it should be 40 or something like that. Divide by 5,000, it's 4 rands. It means I bought them for 4 rands each. Now I'm left with 500. What is the value of this 500 item? It's 500 times 4. This is, I used first in, first out method, which is what we most of the time use. So the value of your inventory at the end of the period is going to be 2,000. Sometimes you can be asked, you can be expected to determine the value, but majority of the time we will be testing the principle of, do you understand how to calculate the cost of sale, where we will be at first level, we will barely mix many principles in the same question. So yeah, that's how you will go about it. Are you happy?
Yes, thank you.
Okay, thank you. Let's move on to the item 4 of 7. Item 4 of 7 is one of those that are very complex but very easy to deal with. Correcting errors. Again, you can correct error on the cash receipts journal, you can correct error on the trial balance, you can correct error on the general ledger, on the general journal, or wherever. You can be asked to correct anyway. For purposes of now, I have chosen to use the general journal to do this error correction. You can be told that an inexperienced bookkeeper of BS cleaners has recorded 10% interest instead of 20% accordingly. Please correct that error. Here is my principle. First thing first, if you are not given what they have done, please start by trying and emulate what they have done before you can correct. Emulate what they have done. Here, they say they have recorded 10% interest of 20,000. When you are recording interest is an expenditure. It means they went and debit 10% of 20,000 is 2,000. They went and debit interest 2,000 and credit, let's call it bank. Sorry, they said it is the Liver Brothers account, sorry, straight payables. It's not a bank interest. And we credit trade payables, Liver Brothers, who is our supplier, 2,000. This is, we're trying to repeat what they have done. Most of the time we'll show you what they have recorded. But if we didn't show you, please don't forget, try to repeat what they've done. And then they say we were actually charged 5%, not 10%. We actually charged 5%, not 10%. I know that people who are very good with mathematics who are going to say 10 minus 5 is 5, and they come and reverse 5%. Yeah, it is correct. However, it can be very confusing if you are dealing with complex transactions. My advice is, before you go there, start by reversing the wrong stuff that has been done. Reverse the wrong stuff that has been done. What was done? We have debited interest 2,000 and we credited trade payables 2,000. Reversing means doing the opposite, meaning we are going to process the same transaction, however, in a reverse order. Where we're going to debit the trade payables and credit the interest 2,000. We are reversing the wrong things that they have done. They said that transaction was wrong because the interest was wrong. What we do, we just reverse everything that they've done. So meaning the net effect is 0 here, because on the interest we said plus 2,000, now we're saying minus 2,000. On the trade payables we said minus 2,000, now we're saying plus 2,000. Then the net effect is 0. We've reversed what we've done, what was done wrong. Now we must record these transactions in a correct manner that they've said. They said the interest charge was actually supposed to be 5%, not 10%. 20,000 times 5%, it's 1,000. So debit interest 1,000, credit trade payables 1,000. Like I said before, I have just chosen to use the general journal to record this transaction. If it was the general ledger, as an example, the T account, it means we're going to have a T account called interest, and then on the debit side we're going to have an amount of 2,000. And we call it trade payables. On a trade payables account, T account, we're going to have an amount in the credit side of 2,000 and have 2,000 like that. And at the end, we'll record all these transactions. Repeat what has been done wrong, reverse it, and record the correct transactions. And even if in other areas, like for example, where it gets a little bit confusing, if you were asked to record this error on the cash books, cash receipts journal, and cash payments journal, those are the opposites of each other. The error, you can reverse it on the other one, where the amount will result in an additional money. That additional money, it means cash receipts. When an amount will result in less money, that less money will mean the cash payment, which will do it there. And sometimes you can just repeat those transactions in a negative format, meaning if it was a plus under the bank account, you put a minus there in reversing that particular transactions. And that's more or less what we do in that regard. Are we happy? Is there anyone who's still having challenges on how to reverse the errors?
Question, sir.
Yes, ma'am.
I see the question there, but my question is, the 1,000 rand that you have now corrected, do we leave it as is, like how you have left it now, or do we add or minus it from that 20,000?
Yeah, but remember what I'm showing you here is the what do we call it? Is the how to correct the error. Because remember, the actual transaction here, if we were not told about the error, we're going to just to be told that they record the interest, the 20,000, the interest on the remaining balance, 20,000 balance, meaning on the trade payables account, this 20,000 is sitting somewhere as the balance on the credit side. And now we were asked to record the interest, which is 10% interest, 10% of 20,000, it's 2,000, which you'll then come and debit the interest and credit the trade payables. If there was no number 2, that's how we will do it, and the transaction will be done. But now, because there is number 2, which says, hey, hang on, there is an error. Actually, that 10% was supposed to be 5%. That's where I say my tip is, first thing first, you must make sure that you repeat what was done wrong, reverse it. If it's not repeated already, reverse it where we have reversed it here by just doing the opposite of everything. Then record the correct transaction, which is the last one. And mathematically, I know we are trying to reason it mathematically. Mathematically, this will come out in having an additional 1,000 on the 20,000. On the credit side of the trade payables account, you would have 21,000 balance at the end. We can quickly calculate it, where you would be having 20,000 as the balance, and then the first one, let's assume plus means debit, minus means credit. Let's assume that for now. Plus means debit, minus means credit. We will be having that 20,000, which is a credit balance or a minus balance. Then the first journal, where you are crediting 2,000, it means minus 2,000. And then the second one, where you are adding 2,000, it means plus 2,000. The third one, where you are minusing 1,000, it will mean minus 1,000. Then your balance is 21,000. Can you see that mathematically? Yeah, your balance on the trade payables is 21,000, which is what you're trying to reason. But remember, we're doing accounting here, not mathematics. So mathematicians, please, let's do accounting, not mathematics. Because even if you go and write somewhere and have 21,000 somewhere on your script, you might get a 0, Because, yeah, we see what you have done, but you didn't correct an accounting error. You corrected a mathematics error, Okay. Let's move on. That was the errors. Let's go to item number 5 of 7. We're not going to spend much time here because we've already dealt with the closing of trading account earlier on, and I think I've hidden it. Yeah, I've done the right thing. I've hidden it. Just to repeat, how do you close an account? The first one is bank, which is an asset account. Remember, assets, liabilities, and equity accounts, they will have a balance, a closing balance and opening balance, and the income and expenses accounts, they close off to the equity account called profit and loss, which then close off to an equity account called retained earnings. So the bank account, how do you close an account? We compare the debit side and the credit side. The debit side, it's 115,000. The credit side, it's 45,000. According to my mathematics, 115,000, it's more than 45,000. So meaning 115,000 will be my total on both sides. Right? Then the credit side, 115,000 minus the total of the credit side, which is 45,500. It's 70,000. This 70,000, we will call it balance carried down. And the very same balance will be called balance brought down in the next reporting period. The capital account, the process is the same because it's an equity account. The process is the same. You compare debit side and credit side. credit side it's 100,000, debit side is 0. 0 and 100,000, the bigger is 100,000, meaning your total is going to be 100,000, and your debit side 100,000 minus 0 is 100,000. You put 100,000 there as balance carried down. Then balance brought down in the next reporting period is going to be 100,000. So the services rendered or sales, this is an income account or an equity account, income account which closes to equity account. And the credit side looks like 10,000 to me, and the debit side is 0. Which one is bigger between 10,000 and 0? The bigger one is 10,000, meaning our totals will be 10,000. Then 10,000 minus 0, it becomes 10,000. What do we call this? This income and expenses, the close off to profit and loss account, which is an equity account. We will call it profit and loss, meaning we will go and open another account called profit and loss, and we'll put that 10,000 accordingly. And when we're done, we'll roll them over to the trial balance, etc. Is there anyone who still have a problem or a question on how to close the accounts? And there are other accounts, I think I've hidden them somewhere. The tax-related account, the VAT input and VAT output. Remember, depending on what we tell you, these ones, they can be closed off to the VAT control account or the SARS data or credit account. Tax control account or SARS data or credit is the same thing. Don't get confused. So meaning, but how we close them is the same. If we told you that you must close them to the VAT control account, it means whatever is the difference is going to go to the VAT control account. If we told you that they go straight to SARS, whatever becomes the difference will go to the SARS data or SARS liability account, depending on what we would have told you at that particular point. So let's move on to the second last item, and very complex, but we can simplify it if we put our minds to it, which is the item number 6 of 7 that we're going to be discussing today, the bank reconciliation statement. The bank reconciliation statement. Not so important in accounting, however, very, very, very important, because even though nowadays with AI, most of the systems they do it by themselves. Only the reconciling items is what you're going to see. Just on a very high level, let me remind you that when you do the bank reconciliation statement, first thing first, you will be having your cash receipt journal and the cash payment journal, and the bank statement from the bank, and the general ledger from your system. But the general ledger will be almost mimicking what you have on your cash receipts journal and cash payment journal. And what you do is that you are going to compare or reconcile. When we say we're reconciling is basically meaning comparing. We are comparing or reconciling the bank statement from the bank and the cash receipts journal and the cash payment journal. So meaning on the bank statement, those who have, I believe we have all seen the bank statement. The bank statement will have a debit side and a credit side, where the other side has the payments, the other side has the receipts. The side which has the receipts or money that we have received in the bank, we are comparing it with the cash receipts journal or the debit side of our bank general ledger or whatever that will be given, or all the monies that we would have received. We are comparing that, and we're going to tick on both sides to say, oh, those transactions that appear on both sides, we tick them, and we'll do the same for the cash payment journal and the payments that are appearing on the bank statement. And after ticking, the transactions that are left behind are the ones that we are dealing with. So this is where we are. Majority of the time when you are asked to do the bank reconciliation statement, we're not going to give you a big bank statement and cash receipts and say tick. Sometimes we might give you that. We might just know how to start the process from the start to finish. However, most of the time we're not going to give you that. We're just going to tell you what transactions were found on the general ledger, but they were not on the bank reconciliation statement, and what transactions were found on the bank reconciliation statements and they were not on the general ledger or the cash books, the cash receipts journal and the cash payment journal accordingly. And you will just need to record those. And when you are recording, I'm telling you high level now, when you are recording things that are missing on the general ledger, we just record them either on the cash receipts journal or the cash payment journal if there are the payments accordingly, and things that are on our cash receipts journal or cash book or the general ledger and they're not there in the bank statement. Those are the things that we take to the bank reconciliation statement, or the errors that the bank has made. Let's say we've deposited 5,000 and it was recorded in the bank as 50,000. And make no mistake, those mistakes do happen, more especially with some banks. I almost mentioned the name. There are some banks that do have those kind of mistakes. So those mistakes do happen. And when it's recorded like that, we go to our bank reconciliation statement. That's where we record those transactions. And when we're recording, I'm not going to repeat cash receipts journal and cash payment. We've done so many times. When we're recording the transactions in the bank reconciliation statement, you treat this more or less like a bank statement, where if you look at it, there are two main aspects that must always be there, and what we'll discuss next week as an exam tip, and I'm telling you now in advance, is that the things that are always be there, let's write them first, so that we don't waste time on other things, so that even if we run out of time, we are able to have capitalized on the marks on obvious or given stuff. Item that will always be there is the balance as per the bank statement. Balance as per the bank statement. On our example, I think we're given. Sorry, we're not given. We'll give it a figure of 20,000. Let's assume they told us that the bank statement had a balance of 20,000. You put it there. And again, I think assessment number 3, if not mistaken, if not true, I think it was 3. This balance here, as per the bank statement, it sits on the credit side. Bank reconciliation is a little bit of an inverse of what we're doing internally. If it's a positive balance from the bank statement, it sits on the credit side. And I think I've explained the logic last time. I'll repeat again. The reason behind having a positive bank balance on the credit side of the bank reconciliation statement is that on the bank side, the bank, when you give them money, to them, they interpret it as if they owe you that money. That's why on their side, on their statements and on their book, they will have it on the credit side. It's almost like a current liability, where they're saying they're owing you the 20,000 rands. Hence, on the bank statement and bank reconciliation statement, you will see it on the credit side. Then there will be a balance from the general ledger. Here, the principles are the same. We've spoken about them 1,000 times. That bank account is an asset account, and assets, they increase on the debit side. On the example that were given, they said on 1 March 2020, the bank account in the general ledger reflected a debit balance of 11,300. It's on the debit side of the bank reconciliation statement, 11,300. You already have 2 marks by just putting these 2 figures on the bank reconciliation statement. So meaning, even if you know nothing about bank record, you can already have 2 marks there by just putting those. So now dealing with the transactions that need to come here or go wherever, I will repeat what I've just said because we're not going to do everything in the interest of time. I'll repeat what I've just said. Things that let me start with the difficult one. If there are errors, ask yourself a question: who made an error, or who has to correct the error? If it's the business which has to correct the error, it means whatever error we're talking about, it has to be corrected on the cash receipts journal or the cash payment journal. If it's a bank that made an error, that error has to be recorded or corrected in the bank reconciliation statement. Because here it's almost like we are rewriting our bank statement. Let me put it this way. Bank reconciliation statement, it's almost like we are rewriting our bank statement. So if it's the bank that made an error, we will record it in the bank reconciliation statement. And again, whether items are going to debit side or credit side, it depends on whether here, are they going to increase our bank balance in the bank or are they going to decrease? All the things that must increase our bank balance in the bank, they go on the credit side. And all the accounts that are going to decrease our bank balance in the bank, they go to the debit side. So if you take those few self-made rules and put them somewhere in your head, you will never have a problem with the bank reconciliation statement. In fact, you can even get 100% whenever there is a bank reconciliation question. So now let's go to our transaction. We're not going to record them, we'll just talk to them. The first one, we're preparing the bank reconciliation statement. The first one, they say on 1 March, these are the totals from the cash receipts and cash payment journal. When they were given to you like that, it means on the cash receipts journal, they said the provisional total of the bank is 66,000. What it means is that here on the bank account, we will have something called provisional total and have an amount called 66,000. And when they say the provisional total on the cash payment is 58,500, what it means on the cash payment journal, there will be something called provisional total, and you will have on the bank account, you will have that amount. They said it's 58,500. You will have that amount of 58,500. Then they say the following information on the March 2020 bank statement received from did not appear in the 2020 cash journals. Who has to correct the mistake here? It's us as the business, because they say the bank have these transactions and we do not have them on our side. It means cash receipt journal and cash payment journal. Then it means all these transactions under C, we're going to record them on the cash receipt journal. Because why? These are legitimate transactions that went through our bank account, but we did not record them in our cash receipt journal and cash payment journal, and now we have to record them. And the principles are the same. I will do them 2 or 3. 2. The first one, a deposit from D. Dawi for his monthly rent, 9,600. It means on the cash receipt journal, we will have 9,600 on cash receipt journal. We will have a transaction 9,600 for that D. Dawi for the rental income. Done. The second one, debit orders. Debit orders, we said last time when we were doing the bank record, these are the monies that the bank has paid to your suppliers on your behalf. You sign the debit order at the beginning of the year or whenever you are taking an account, and the bank will just pay these monies on your behalf. They are all expenses. Water and electricity payment means cash payment journal, meaning on the cash payment journal, we're going to have all those transactions recorded here. I'm not going to record them. That's more or less how it is for all of them up until the last dot. Is there anyone, sorry, maybe we'll ask questions when we're done in the interest of time. Then the following number D, the following information in the March 2020 cash journals. This one, meaning it's on our cash receipts journal and cash payment journal and did not appear on the bank statement for March 2020, meaning we have these transactions, perfect, legitimate transactions that we have recorded on our cash journals. However, they have not yet reflected on the bank. So meaning who has to correct the mistake? The bank, meaning these transactions are going to go to the bank reconciliation statement. The first one is the outstanding deposit of 21,700. Outstanding deposit, meaning someone has deposited money in our bank account, maybe gave us the deposit slip of 21,700, and the bank has not yet added this money. Now on the bank reconciliation outstanding deposit, we all know that it's 21,700, but the question is, does it go on the debit side or on the credit side? Here's the trick. The trick is to ask yourself, will that amount increase or decrease my bank balance in the bank? 21,700, which was deposited in the bank, but it was not deposited, it was not reflecting. It will increase our bank balance, meaning on the credit side. Remember, the bank sees this thing in opposite format. 21,700 will go to the credit side. And EFT to EFT is when we have paid someone using internet banking of 7,200, which is meaning we have paid someone using EFT, but it does not appear on the bank balance as yet. I think FNB is the bank which likes doing that. Sometimes even when you are swiping on the toll gates with your bank card, you will swipe this week. The transactions will only ring in your phone after 2 weeks. You get surprised. Hey, what's happening? Durban, but I'm here. Oh, last week I was in Durban. These are last week transactions. So it's instances like that where the transactions appear later on the bank statement while you have already incurred them. If you are a business, you will be having the till slips or the toll gate slips that your bookkeeper will have recorded already in the cash payment journal, but the bank has not yet deducted. 7,220 outstanding EFT. Does it go to the debit side or the credit side? Remember, you ask yourself a question. You ask yourself a question. Will the 7,220 increase or decrease my bank balance? Because these are the payments, they will decrease your bank balance. Decreasing bank balance meaning on the bank statement on the opposite side, which is the negative side, which is 7,220. I will pause here on the bank reconciliation statement. And remember, at the end, if you have done everything properly and correctly in and between, the debit side of the bank reconciliation statement must equal the credit side of the bank reconciliation statement. I will pause here on the bank recon. Is there anyone who has a question on bank reconciliation statement before we proceed? Bank reconciliation statement, if it comes, of which I doubt, but if it comes, I'm going to get 100%. Bank recon. Kutwano.
Hi, sir. Could you please explain to me the transaction where it says interest on the favorable balance?
Okay.
How do you record it, that one on the cash journals?
Yes, interest on the, yeah, now 85 rands. Remember this transaction, they say the following information on the March 2020 bank statement received from the bank did not appear in the March 2020 cash journal. So meaning the bank has already recorded 85 rands interest on the bank statement. However, we have not yet recorded the 85 rands on the cash receipts journal. And I know where your question is going. Before I go directly to your question, let me say this. Remember, the first question which you need to ask yourself is, who has to correct the error? Who has to correct the error? Who has to correct the error? If it's the bank that needs to correct the error, it's bank reconciliation statement. If it's us, we have to record on either cash receipts journal or the cash payment journal or the general journal, depending on what we've been asked. So here, it means it's us, because the bank has already recorded this. It's us who did not record this in the cash receipts journal accordingly. And again, I know the gist of your question, I think, is this word favorable balance. When we say favorable balance, it's just a fancy word, or just to confuse you a little bit. It means debit balance or positive balance, let me put it that way, positive balance of 85 rand. And if it says unfavorable balance, it means it's the negative balance. So since it's the positive balance and we have earned 85 rands interest, it means when we earn interest, it's money in, it goes to the cash receipts journal. So in the cash receipts journal, we are going to have that 85 rands for the interest.
Oh, okay, thank you, sir.
Yeah. But if it was saying unfavorable balance, it was going to go to the cash payment journal, because it will be us paying the interest, and then it goes to the cash payment journal. Thank you so much for that. Let's move on to the last part of our class, and the most important one. They say save the best for last. If you were sleeping, please wake up. I can tell you for free, without fear of contradiction, that depreciation is going to be there in all assessment number 4 and assessment number 5, because this is a very important part of accounting, and is a crucial part of accounting. And I think there is even a module in year number 3 which is dedicated to property, plant and equipment. That's how important this particular standard is in accounting. So I've prepared a simple question here. We may steal your 2 minutes, just bear with us. We may go over by 2 minutes, but I will try to be as quick as possible so that we all go and write and pass next week. I've prepared a simple question here which says BS Cleaners as 28 February 2023 financial year. This is very important. The dates are very important in accounting. Our financial year end is ending when? 28 February 2023. It means it started when? It started on 1 March 2022. That one you must just put it in the back of your mind, and you must just understand that if it's ending 31 December, it means it started 1 January the previous year. If it's ending 31 March, it means it started 1 March the previous year, etc., etc. So here our financial year end is 28 February 2023, and there is a statement here, very, very important. It says all assets were purchased on 1 March 2022, meaning the beginning of the financial year, except for computer equipment that were bought on 1 March 2021. So meaning only computer equipment are 2 years old here. Everything else is 1 year old. Now, they say calculate depreciation for the motor vehicle. Let's see by the raise of hands who wants to calculate the first depreciation for us. They say motor vehicles, straight line method, 5 years, they were bought 1 March 2022 for 600,000. wants to calculate depreciation for us? Pato. Pato Lillian, calculate depreciation for motor vehicles for us. The other person, please calculate equipment, and the other person, please, in fact, let me point. Pato, calculate depreciation for motor vehicles for us, straight line method, 5 years. And Daphne, you have not spoken today. Daphne, please calculate the depreciation for us for the computer equipment using diminishing balance method, 20%. And we bought these computers for 100,000, and we've bought them on 1 March 2021. Daphne, please calculate the depreciation. And with Tepo, I don't remember you speaking today. With Tepo, please calculate the last one for us. Machinery, we bought this with this machine for 300,000 on 1 March 2022, and the depreciation for this year it has produced 2,000 units. Sorry, I think this is 20,000. 20,000 units out of 100,000 units, or the machine is capable of producing 100,000 units, and this year it produced 20,000. With Tepo, you will do machinery. Daphne, you will do computer equipment, and Patu, start with the motor vehicles. Patu, the stage is yours. Patu, how much is our depreciation?
Sorry, sir. I had just stepped out of this candidate now. So let me calculate.
Okay.
Someone can go ahead.
Okay. Please calculate number 3 as well. You will assist Daphne on number 3, which is the machinery. Just calculate machinery as well, Patu. Kutlwano, your hand was up. You want to help us with motor vehicle depreciation? Yes, Kutlwana, the stage is yours.
Hi, sir. Since this one is straight line, I think it's very straightforward to me. So, in my own understanding, since there are no percentages for the motor vehicle, I was gonna take the motor vehicle at cost, divide by the 5 years, and then get 120,000. Yeah.
And
I said there are no percentages.
So you were doing the one for motor vehicles, and you said you will take the 600,000.
Yes.
You said you will divide it by 5.
Yes, sir.
My computer does not want to type divide by. I don't know. Something is wrong. Divide by 5.
Yes.
And how much do you get?
It's 120,000.
120,000. Do you know what is this 120,000?
Is it the killing?
This is depreciation for a year, and I think, of course, here we are calculating depreciation from 1 March 2022 up until 28 February 2023, which is coincidentally it's 1 year. Sometimes you may need to calculate depreciation for 6 months or for 3 months. Just bear that in mind, that this is depreciation for a year. If you were asked to calculate depreciation for 3 months, meaning you are still going to divide it by 12. A year is 12 months. You're still going to divide it by 12 because you are calculating for 3 months and multiply by 3. If you are asked to calculate depreciation for 2 years, it will barely happen. It means you will take this annual depreciation and multiply it by 2. So this is depreciation for a year. Okay, let's move. I'm trying to remember who did I assign to deal with computer equipment. The computer equipment, is it you, Daphne? I don't remember who did I ask. Bali, do you want to assist us with computer equipment? How would you go about calculating depreciation for computer equipment using diminishing balance method? Oh, sorry, Lungi.
Yes, sir. Diminishing balance method.
Yes.
So I'll just briefly give the answer and try to explain to the people who might not understand. Diminishing means reducing. So the asset is reducing, it loses value, depreciates from the moment it leaves the store. So we have computer equipment, diminishing balance 20%. So basically what we are saying is that the equipment at cost is 100%. Our diminishing balance method is 20%. We're going to start off by saying 100,000, multiply that by 20,000 is equals to, multiply by 20% gives us 20,000. The closing carrying amount will be 100,000. We minus that 20,000 because it is reducing balance method. It will give us 80,000 for maybe the first year, for example.
Yeah, continue.
That is year 1. So if we continue maybe to year 2, we're still calculating diminishing balance method. The asset is reducing. The start of the year value will be the amount that we got. So that 80,000 will come for year 2. It will be the start of year value. It will be 80,000. We're going to multiply it again by the 20%, which will give us 16,000 rand. The carrying amount will be 80,000. We minus that 16,000 rand, we get 64,000 rand. That's for the closing carrying amount for year 2. Ganjalo, ganjalo.
I'm trying to write as you speak, Daphne. Okay, I'm just trying to write quickly. So our depreciation for computer equipment, it will be 16,000. As Daphne has explained, I will just repeat what she said very quickly. That when we are using the diminishing balance method, this is where depreciation is calculated based on the carrying value or the balance of the value of the asset at the beginning of that reporting period, and underline beginning. Here we have computer equipment that were bought for 100,000, and this computer equipment, they were bought for 100,000, and they were bought when? On 1 March 2021, on 1 March 2022, which is 2 years ago. 2 years ago. And it means on year 1, which is as at 28 February 2022, which is our year 1, depreciation, you will take the balance at that date, which was 100,000, or at the beginning of that reporting period, which was 100,000, times 20%, which becomes 20,000. Then you calculate the carrying value and or the asset balance as at the end of that particular reporting period, which becomes the beginning of the year 2, which is the current reporting period, and it's 80,000. Depreciation for year number 2, you are taking now 80,000 times 20%, which became 16,000. Then you also calculate another balance at that particular point. Since now we are on year 2, which is 21 February 2023, our depreciation for this year, that is needed this year, it's 16,000 rands. Okay, if it was a straight line method, as Kutwana has indicated earlier on, we're just going to take 100,000 times 20%, it will be 20, 20, 20, 20 for all 5 years. Unfortunately, because this is diminishing balance method, you calculate the balance of the asset first, then you use that balance to calculate the depreciation. Remember, the balance at the beginning of the year in which the asset was bought, diminishing balance and the straight line will be the same, because by then there is no depreciation to minus asset. The last one, Daphne, are you the one assisting us with the last one? The last one is the machinery bought 1 March 2022. Daphne, we are using unit of production method. This machine in total, it will produce 100,000 units, but in the current year they say it only produced 20,000 units. Pathu, do you want to tell us? Pathu?
No, sir, I'll pass.
Ndovathemba kodwa raro Pathu mara. Kutwano?
So you're going to, so since the company, they are using the unit of production method, you're going to take the 20,000 divided by the 100,000, then you're going to get 0.2, meaning the machine, it was only used for the 20% of its lifetime for that year. And then you're going to take that 0.2 multiply by 300,000 rand, and then you'll get a depreciation of 60,000 rand.
Yo, okay. You are correct, but I don't like that method. It can be confusing to someone who's not a mathematician. You're correct. That's exactly how you will go about it. However, what I would rather prefer is to ask yourself, how much value does the machine lose per unit, where you will go and take the 300,000 which we bought it for, and in total you ask yourself, how much value does it use per unit, meaning you will take the 300,000 that we bought it for, divide by the 100,000 units that it will produce in total. So meaning it will lose 3 rands per unit. 3 rands per unit. And in this year we have produced 20,000. So meaning 20,000 times 3 becomes our depreciation for the current year. What you have done and said, Kutlwana, it's correct. It's just that it may be a little bit confusing, because remember, percentages are not always straightforward and fixed. Can get comma something, which might create problems there. But if that's how you understand it, you can still go that route of calculating. But what I find to be easier is to take the cost of the machine and divide it by all total units that it is going to produce, then determine how much value does it lose per unit, then determine the depreciation depending on how much units has it produced this year. And I will discourage you to use that method as well, Kutlana, because as you progress with your accounting learning on level 3, I think, there is something called change in estimate, which happens in and between. It's not covered in your syllabus, where they will come and tell you, hey, this machine, we thought it will produce 100,000 units. Things have changed. It will now, maybe COVID happened and this machine is now not working well. Instead of 100,000, it will produce 80,000 units. Or we come and say, hey, this was a solar panel. We thought it will produce 1,000 megawatts, and the sun was too hot this year. It's going to produce double, 200,000 units or 200,000 megawatts. That may create a lot of complications on how you calculate it. So if you stick to this principle, it will save your life. So meaning, try to learn how to do it this way, and it will save your life. Any other question on depreciation before we move on to close the class? And I will repeat, depreciation is definitely coming on both assessment 4 and 5. I didn't see it, but because it's important, I know all important things, they have to be tested time and again. So you have to know. And for me, the most common way of calculating depreciation is the straight line method. And the straight line method is not always the number of years. Sometimes we can give you the percentage, but it's just a matter of multiplying the percentage by the cost or by whatever that you would have been given. And then you get your amount. And the dates are very, very important when calculating depreciation. To say when was the asset bought, and where are we now, and how many years have passed since the asset was bought and now, and how many years are we required to calculate depreciation for. Remember, I've also told you about something called accumulated depreciation. Don't be fooled. Accumulated depreciation is just the total depreciations for all years. For example, if we were working on the computer equipment and ask you how much is the accumulated depreciation for the computer equipment, it will be depreciation for year number 1 and depreciation for year number 2, which becomes 36,000. That would be your accumulated depreciation. So don't worry if you see fancy words like that. It just means total depreciation since the asset was bought to date. In the absence of questions,
the total with debit, it's the accumulated depreciation.
Yes. Okay. Thank you so much, colleagues. We'll meet again.
Thank you, guys.